Are you planning on leaving Canada permanently? Well, if you don't manage your finances carefully, you might be throwing away thousands of dollars in the process. In this video, I'll break down how your TFSA, RRSP, CPP, and OAS are affected when you leave Canada. I get this concern all the time from people like retirees that are looking to escape Canada's cold winters and high costs, or from digital nomads or remote workers who want to leave Canada's high taxes. And so I thought I'd make a video where you can find all your answers here. I'll cover tax implications, benefits you might lose, and smart financial moves you can make before you start packing your bags. And don't miss my special tip at the end on what to do with your house before leaving Canada. And this advice could save you tens of thousands of dollars. Let's start with my personal favorite account, the tax-free savings account, otherwise known as the TFSA. What happens to it when you leave Canada? Well, for this video, I'm going to assume that you've already made the choice to become a permanent non-resident of Canada and are permanently moving abroad. When you leave Canada, your TFSA is subject to several important changes. I'll start with the good news first though, the TFSA account status. One good thing is that your TFSA maintains its tax-free status in Canada even if you become a non-resident. Another good thing is your withdrawals. You could still withdraw funds from your TFSA while living abroad. These withdrawals will be added back to your contribution room, but here's a key point. You can't use this room again until you become a resident of Canada again. So be very careful of that. The third good point is repatriation. If you decide to return to Canada as a resident again, you can resume normal TFSA activities, including making contributions up to your available room. And here is the bad news about your TFSA is you can't make new contributions to your TFSA while you are a non-resident of Canada. However, your existing TFSA can remain open and continue to grow tax-free. If you do contribute to your TFSA while as a non-resident, you may face hefty penalties of 1% per month on the contributed amount. For example, if you contribute $5,000 to your TFSA while being a non-resident, you could incur a penalty of $50 per month until the amount is withdrawn. Over a year, this penalty could add up to $600, which greatly reduces the benefits of your investing. Contribution room. You do not accumulate new TFSA contribution room for any of the years during which you are a non-resident. Tax implications. While the growth within the TFSA remains tax-free in Canada, your new country of residence may tax the income or gains from your TFSA according to its tax laws. For example, if you move to the US, they don't recognize the TFSA, so the IRS will tax all the income and gains from it. That surprises a lot of people that are about to move to the US. That's why it might be a good idea to collapse the account in this case before moving to the US. The point is, you have to be aware of the tax rules of the country you're moving to. And that's something you'll hear throughout this video. Now, here's a pro tip for your TFSA. Before you leave, max out your TFSA contributions. This way, your investments can continue to grow tax-free while you're abroad. Another reason to do that is because you can't contribute anymore when you are abroad. Next up is the RRSP and what happens to that when you leave Canada. First up, let's talk about contributions and withdrawals. As a non-resident, you can still contribute to your RRSP if you have available contribution room from Canadian earned income. That's even if you live abroad. So that's a little different than the TFSA. But without Canadian income as a non-resident, you won't generate new contribution room. And any withdrawals you make as a non-resident are subject to a 25% Canadian withholding tax. Now, this 25% rate can be lower if there's a tax treaty between Canada and your new home country. Next, let's talk about the tax implications. Your RRSP investments will keep growing tax deferred in Canada. But remember, your new country might tax the income and gains within your RRSP. This varies country to country. Some tax treaties might offer tax relief or exemption. For example, the US will not tax the income and gains within your RRSP. But if you move to a different country, it might, depending on their tax treaty. Canada has tax treaties with 91 different countries, with some of the most common ones being US, Mexico, Costa Rica, and Thailand. And you could find the full list here. You could keep your RRSP open and manage your investments even as a non non-resident. But be mindful of currency conversion rates and fees if you plan to withdraw the funds. These can impact your return. As a non-resident, you can even convert your RSP to a registered retirement income fund, otherwise known as a RIF. Withdrawals from your RIF will have similar withholding tax rules, usually 25%, unless, again, a tax treaty reduces it. Minimum withdrawals, as usual, are based on your age and the value of your RIF, just as it would be if you were living in Canada. It can get complicated though. For example, if you're moving to the US, due to the tax treaty between Canada and the US, the withholding tax rates on RRSP withdrawals can be reduced to 15% for periodic withdrawals. So it really depends on the specific tax treaty of the country, again, that you're moving to. And the good news is that if you decide to come back to Canada, you can start contributing to your RRSP again based on the contribution room of any new Canadian income you generate. Another very common question that I get is, what are the best ways to withdraw from your RRSP after you retired? Which I covered in detail in this video here, so you can click on that if you're interested in that. And if you're finding this information useful, don't forget to like and subscribe to the channel. Next up is the CPP. What happens to your Canada pension plan, otherwise known as your CPP benefits, when you become a non-resident? First off, it's important to note that the CPP is based on contributions made during your working life in Canada. The good news is your CPP benefits will travel with you if you move abroad. This means the amount you receive abroad remains the exact same as if you lived in Canada. Think of CPP as a trusty old suitcase. It holds everything that you've packed over your working life in Canada, and it travels with you wherever you go. So your CPP will be paid the same amount regardless of where you retire, but what about the taxes? Well, CPP payments may be subject to withholding taxes depending on the tax treaty status of your new country of residence. Again, I'm going to use the US as an example because it's the most common country that Canadians move to. So if you're moving to the US, there's a tax treaty in place that can reduce or even eliminate the withholding tax on your CPP benefits. But without a tax treaty, you could face a 25% withholding tax on your payments. Canada has something called a Social Security Agreement with over 50 countries to ensure your CPP coverage continues uninterrupted and to avoid dual contributions. These agreements also coordinate pension benefits for those who've lived and worked abroad. And you can check out the list here. It's also worth noting that CPP survivor benefits and child benefits will continue to be paid even if the recipient lives abroad. So your family benefits are secure no matter where you are. Now, how exactly do you receive your payments though? Well, you have a couple options. Your CPP payments can be deposited into a local bank account in the local currency or into a Canadian bank account, and you could somehow transfer it with a service such as Wise to your new bank. If local bank transfers aren't feasible, your payments can even be mailed as checks in Canadian dollars, though this is probably not the best idea. While the amount you receive from CPP doesn't change, how it's taxed in your new country is something to look into. Some countries might tax your CPP benefits differently, and it's crucial to understand these implications to avoid any surprise. And here's a pro tip for your CPP. Consider CPP splitting. If you're married or in a common law relationship, explore how to split your CPP pension to reduce your overall taxes. Next, let's explore what happens to your old age security or OAS benefits when you move abroad. First, let's cover the basics. So your OAS is based on the time you spent in Canada and can be collected as early as age 65, with the possibility of delaying it up to age 70 for increased benefits. To receive OAS abroad, you must have lived in Canada for about 20 years after turning 18. If you haven't met this 20-year threshold, you might still qualify if you worked abroad for a Canadian company or lived in a country with a Social Security Agreement with Canada. And you can see the full list here. However, years spent in these countries do not count towards the OAS benefit amount. Now let's talk about the benefits. If you meet the requirements to get paid for the OAS benefit amount remains the same no matter where you live. However, additional OAS benefits like the Guaranteed Income Supplement, otherwise known as a GIS, and Survivor Allowance require you to reside in Canada to receive them. So if you want to receive those benefits for your GIS and other allowances, moving abroad will actually disqualify you from getting them. Next, let's discuss tax implications. High-income earners may face the OAS clawback, also known as the recovery tax, which applies to these earnings over a certain threshold. This clawback still applies abroad unless you move to a country with a tax treaty with Canada, which potentially allows you to bypass it. Non-residents typically must file a T1136 form annually to determine any required repayments. Countries without a tax treaty with Canada may impose a withholding tax on OAS payments, typically about 25%. For example, if you move again to the US, there will be no withholding tax on your OAS due to the tax treaty between Canada and the US. Always, always, always check the tax treaty details for your country you plan to move to. Remember, to collect OAS abroad, you must file an annual tax return reporting your worldwide income. Here's a pro tip for your OAS. Income management. If you're at risk of the OAS clawback, manage your income through strategic withdrawals from other retirement accounts. Also, consider deferring OAS payments up to age 70 to increase your monthly benefit by 0.6% for each month deferred. Here's a bonus tip for those planning to move abroad, and that is what to do about your house. If you're leaving Canada before you leave, consider selling your home to avoid huge taxes. Selling your principal residence after you become a non-resident can be very harsh due to the large capital gains tax. To avoid this, selling your home before you move is a smart move, as Canada doesn't tax principal residences for residents of Canada. Here's an example if you don't do this, how it could cost you a lot of money. Let's say you buy your home for $500,000 and the value appreciated to $800,000, and then after that you decided to move abroad. If you sell the home after you become a non-resident, you might have to pay capital gains tax on $300,000 increase. Depending on your residency status and the applicable tax treaties, this could result in a significant tax bill, potentially upwards of $75,000 or more. This huge tax bill could have been completely avoided if you had just sold your property before leaving Canada, so definitely look into that before leaving. If you're seriously considering moving abroad, it's crucial to consult with a cross-border tax professional to really understand the specific details and implications. Ideally, you'll want to look for one both in Canada and the country that you plan to move for. Here at Blueprint Financial, we collaborate with accountants in Canada, specializing in expat services to ensure that you get the best advice and support. You can find more information about this, including this video in written form, on our website at blueprintfinancial.ca. Don't forget to like and subscribe this video and check out our next video on how to pay less taxes in